Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. Well, all last week, all eyes on this man, coming in with what Dr. Ed is referring to as the Home Mortgage Savior Act done by the Fed. Because not only that we read that they're going to, over the next period of time, move $400 billion out on the yield curve, but it doesn't only include treasuries, but also includes mortgage backs. Dr. Ed feels that from the figures that they were seeing in the housing market, that they felt that they needed to do something very specific to get housing moving. Will it work? A lot of people also calling this, of course, the yield curve twist, which, if it does work, my feeling is could be very detrimental to the net interest margins of community banks, which are already suffering. But this brings back the whole aspect of really trying to control your deposit rates overall in here. And once again, what I've been suggesting is lowering deposit rates aggressively. Now, some people think it might have an upward move in terms of shorter-term rates, but let's take a look and see what the Bernanke Mortgage Savior Act has done so far. And when we look at it in terms of the yield curve in here today, is that, of course, on Friday we saw treasuries decline. We also saw the stock markets dropping dramatically in here because of the size of this and also because of what they really saw as a certain fear in the Fed that you also had that word recession come up again. So what we saw was on Friday in here on the 10-year Treasury is that we saw the 10-year Treasury declining in here almost to a 1.70, jumping up a bit in here today to about a 1.89, but still lower than that 2% that we've been existing with over the period of time. If you look at this, though, very, very little change. In fact, we hit a low on the 2-year that we talked about last week at 0.15. Now today we've moved up to about a 0.22. So will short-term rates continue to rise in here and longer-term rates continue to drop? Watch for the economy, because once again it's our belief that we are not going to see any sort of recession type of situation. In fact, there was a Bloomberg article on Friday talking about the railroads in here, and the railroads looking at the activity that they're seeing now and into the future, and they said it looks nothing at all like a recession out there. So once again, it seems that this is more of a financial recession, meaning that the fear out there that's driven the stock market down to the point that it's at, which we've still contended really is ridiculous, and also pushing interest rates to the point where they're at, is that when we look at this whole balance between the economy and where things are, in my mind, it's actually imbalanced. So when we look at it and look at the future in here, is that I still think that you're going to see upward movements in terms of the 10-year going back above that 2%, and still the short end based on the level of economic activity remaining approximately where it is, which would basically put that whole aspect of a yield curve twist into doubt. I also wanted to talk about the greatest introduction that I've ever had. I was down in West Virginia at MVB Bank, and I was leading a management strategic session. And their chief credit officer, Dave Jones, came into the room and introduced me. Not only was he wearing a bow tie, but a big thing, and this really went right to my heart, was him talking about a book that he read back in 2007. Which is Dr. Ed and my book on the art of risk. And he said that as a chief credit officer, that reading, especially the section on credit risk, that it prepared him for what came down in 2008 and 2009 and what the bank is experiencing this year. And prepared him to the point where when you look at MVB Bank's actual numbers, is that all banks are affected during a credit cycle, but their performance is much better than both the national and state credit performance, and that is fantastic. But the thing is, he said that this book really prepared him in terms of dealing with that credit risk, not only before the Great Recession, but after the Great Recession. This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.